Hey, what's up everybody? It's another edition of Whiteboard Wednesday. And what I have for you guys this week is I have a video, or I'm going to talk to you guys about analysis of rental properties. So a little bit of a backstory on here. When you buy rental properties, there are a few things you want to make sure you consider. First and foremost, you want to make sure you think of the cash flow that the property is going to provide for you. We're going to break down that number here in a few minutes, but that's the first and foremost thing you want to make sure that you're paying attention to when you're analyzing a property to buy as a rental. The second thing you want to make sure that you're doing is making sure that you're buying at a discount if you have to do repairs. You always want to be buying properties with equity. You never want to buy a property at the height of the market, because if the market shifts, you're stuck holding the bag, and a few things might happen with that. So we always still evaluate based on the after repaired value of a property, kind of like I've been showing you guys in the last few other Whiteboard Wednesdays. The third thing you want to make sure you're doing is you're buying in a heavily rental area. You don't want to buy houses in A-class neighborhoods. Very few of those houses are rentals, and those are also areas where they take the biggest hits on rentals. So if you're buying a house, say in the $400,000 range, and the market takes a shift, those are the hardest houses to make sure you get that right cash flow, and the after repaired value or the as-is value is going to drop significantly, which means that you're gonna have a harder time renting that property because people can't afford to rent in those neighborhoods anymore. So here's how we're going to break this down. This deal was actually brought to me by a real estate agent that really didn't understand how to do this. And that's okay, because we ended up educating them how to do that. And now we're bringing that person, or we have brought that person on board to Outfast Realty and Investments, because they want to learn how to do this stuff properly. So the next part of this video right now, I'm going to break down to you exactly how you're going to analyze this particular deal that he brought to me. And now I'm going to show you how he broke it down and where he was wrong on his figures. And I'm going to show you the right way to do it. So here we go. Okay, so here's some of the details of the property. This house was located, or is located, in an A-plus neighborhood in Northeast St. Pete. I got some of the details right here, so let me go through them. Essentially, they are asking about a little over $400,000 for the property. That alone right there tells me that we're in a much higher rated neighborhood than we would typically buy a property in. So again, asking price was $410,000. Lots of money to pay for rental property. Not a good use of your money, and I'm going to explain that a little bit later is too. The rental estimate, I have RE here, is approximately $3,250 a month. That sounds awesome, but here's the thing. We're already, even if you just don't account for anything else in this particular deal, like, you're already at pretty much the maximum amount of money that you would do for the net profit on a deal. Basically, the reason is because if you take this and you divide it, multiply it by 12, divide it by that, you're basically making just a little bit over a 10% gross cap rate. Not a good number. In fact, you're actually not even making a 10% gross. You're just a little bit shy of that. So already we're at a 10% gross. If you bought that property at $410,000, that's a 10% gross return on your money every single month. That's not good, okay, folks? So let's go a little bit harder, or a little bit deeper. If you start figuring insurance and all the other expenses such as property taxes and whatnot, he figured about approximately $11,000 NOI, which stands for net operating income per year. That's not a lot of money, especially when you're putting up $410,000. Okay, and he came up with a 7% cap rate, which realistically isn't the right number anyway, and I'm not trying to pick on him. He just did numbers the way that was probably taught to him by some other real estate brokerage or some other person out there that really doesn't know how to do the numbers. Okay, so in all reality though, the one thing that he really did not figure in the net operating income were two different things. One is going to vary from location to location, and if you're not here in Tampa Bay, you're probably not even aware of this, but in this particular situation, this is in Northeast St. Pete. The first and foremost thing I always think of when I think of buying a property in Northeast St. Pete, flood zones. So he did not figure into his net operating income what the flood insurance was going to cost. And in that area, you're probably talking like $300 a month. So multiply 300 times 12 months, and your net operating income is going to shrink even further, okay? So again, this looks like it could be a decent on paper because you're going to make $3,250 a month, and if you got a mortgage on it, you're going to make some cash flow. But if you're not looking at the whole big picture, you could miss out on this or you could make a big mistake, I should say, on a deal like this. The other thing, the second thing that he did not include in this particular situation is vacancies. And this is the biggest thing I believe that most new real estate investors never think about, okay? And I'm going to break this down, and I'm going to be very blunt with you. For, the net operating income is based, he had it on 12 months. Rarely are you ever going to get 12 full months of rent. And here's why, at least per year. Per tenant you will, most likely, unless you have to evict, and that's a whole nother Whiteboard Wednesday for another day. But let's be real here. So say you get a tenant in there who's going to rent for 1 year. You've qualified them. They've used us to place the tenant. We've gone through all the background checks. They've gotten a clean credit report. They've never had an eviction. All that stuff. They're the perfect tenant. Great. Well, say they only rent for 1 year, 12-month term. What happens when they don't renew? They decide to go buy a house. They want to go rent another place. Yeah, they're moving out, but even if they move out by the 30th or the 31st of the month that they're supposed to leave, guess what you have to still do? You're calling your handyman, you're calling your painter, you're calling a couple guys out there to lightly renovate that property to get it back into rental grade. Rarely, if ever, do tenants leave the property in the same condition that you gave it to them in. So there's always going to be work, no matter how clean your tenant is. There's always going to be paint that has to be done. There's always going to be a deep clean. There's usually always repairs that have to be made in some way, shape, or form. If you're an investor and you own rental properties, comment below that there's always been times that you had to remodel, or I should say repair that property when you have to replace a tenant. So let's say that takes a week or two. Well, guess what? You can't really show that property to prospective tenants until that process is done. Okay, so say it takes 2 weeks. Okay, worst case scenario, it takes 2 weeks. Well, it's still going to take you about a week or two to start showing that property, start qualifying tenants. So by the time it's all said and done, we ballpark about 30 days when we analyze our properties for vacancies. It's the number one thing that most new real estate investors that are buying rental properties forget to figure out in this big, huge formula. And I haven't even broken down the formula in the right way yet, because you have to start thinking about what goes into that net operating income. And some of the things you also have to think about too. When you buy a property, biggest thing too that a lot of people forget about is that a lot of times you'll buy a property from a homeowner who might have been living in that property, and guess what? They have property taxes based on the homestead exemption here in Florida, which means that they're paying a much lower property tax than you as the investor who buys this property, say for $410,000 or whatever the right price is, which we can get into in a little bit. If you don't figure out that your property taxes are almost going to double, there is your net operating income coming down even further. Here's how it works, guys. Here's how we do this as a very, very, very quick calculation of the property. Okay, so what we want to always do, and again, I could break this down really deep and we can get you a calculator if you want. Reach out to us if you want a real calculator that can help break down all these numbers. But here's how it really works in simple layman's terms to make it super easy and super fast for you to analyze a property. Let's say the rent is $32.50 a month, okay? That's already way lower than what we want to be, and here's why. If you buy a property for this $410,000 right here, okay? We always figure that we want 1% of the gross rents per month should be equal to the purchase price. So if you're buying a house for $100,000, that gross rent should be $1,000. That's 1% of the deal. So if you're buying a $410,000 house, your gross rent, your rental estimate should be $4,100 per month. We're already underneath that number at that point. So for this to be a rental property, we have to buy this house essentially for $325,000. Huge difference. Do you think this person that has a perfectly meticulously maintained property that's listed this property for $410,000 is going to, just because your numbers need to work for a certain number, that you need to be buying it for $325,000? Hell no. They're not buying that. They're not selling that property for you for an $80,000+ discount. They're just not going to do it. And that's the problem, is that you cannot do these deals sometimes in these higher end neighborhoods unless you're willing to take a big risk and take a lot lower return on your investment. And here's the thing, this property is also at the height of the market, or we're close to it if we aren't already there. So the point is, like, if the market takes a shift and now that house is not worth 410, say it's only worth 390, you're still way under, because guess what happens? That person that's paying $32.50 a month may not be able to pay $32.50 a month. The market also shifts on the rental side, because that type of person loses their big corporate job. They don't have a place to live anymore. They can't afford $32.50. Their rental estimate might go down to $1,800. Now you're out of a tenant, and now you have a vacancy rate more than that one per every 13 months I was talking about. So there are so many things that go into evaluating a rental property, but we always like to stick to the 1% rule. If you'd like more information about that, all you gotta do is reach out to us. But again, if you need the actual in-depth calculator, if you're that examiner person that likes to know every little detail about everything, sure, fine, shoot me an email, comment up below, and I'll be sure to make sure that you get the rental calculator emailed to you. So I hope you found value in this and breaking this down, because this is what we teach here at Outfast Realty and Investments to our investment agents, to analyze rental properties in rental neighborhoods based on cash flow, based on after repaired value, and making sure that we're buying these properties in and around rental areas only. Let me know if you have any questions. See you next week on another edition of Whiteboard Wednesday. See ya.